example, how to spot algorithmic trading in Forex, identifying momentum in the market. In this video, we explore how to identify when algorithmic trading is driving momentum in the Forex market. Learn key strategies and techniques used by algo traders to capture market moves and how you can spot them using various indicators, tools, and techniques. Whether you're a beginner or experienced trader, understanding this behavior can give you an edge in your trading strategy. Introduction. Hey everyone, welcome back to the channel. In today's video, we're diving into the world of algorithmic trading in the Forex market. Specifically, we'll be answering three major questions that can help you understand how to spot when algorithms are driving momentum in the market. If you've ever noticed sharp price moves that don't seem to align with news events or technical analysis, there's a good chance that algorithmic trading could be at play. In this video, we'll break down exactly how you can identify when algorithms are influencing momentum and what that means for your trading strategies. Let's get into it. 1. How to spot momentum in Forex using algorithmic trading. Algorithmic trading uses mathematical models and computer programs to place trades based on a variety of signals. But how can you spot when algorithms are the driving force behind the market's momentum? Well, first off, high-frequency trading is a common feature of algorithmic strategies, especially when it comes to momentum. Algos often create sharp price movements with rapid fluctuations that occur within very short time frames. For example, if you notice sudden, large price shifts that occur without a significant news event or fundamental change, there's a good chance that algorithms are in control. Another key sign to look out for is perfect retracements at key support and resistance levels. Algorithms often act with precision at these levels, pushing the price in a defined direction. You'll also see large price movements that seem almost mechanical, with prices rising and falling in near identical patterns or grids. These are key indicators of momentum trading driven by algorithms. The bottom line is, if you see sharp price moves that seem to occur without reason or follow a predictable pattern, you might be witnessing algorithmic trading in action. 2. How do you identify which timeframes algos use for momentum? One of the hardest parts of algorithmic trading is figuring out which timeframes the algorithms are targeting. Since algorithms work across multiple timeframes, pinpointing their exact behavior can be tricky, but there are ways to identify where momentum is building. To start, look at momentum indicators like the RSI, Relative Strength Index, or MACD, Moving Average Convergence Divergence. When these indicators are aligned across smaller time frames, like the 5-minute or 15-minute charts, and continue to show momentum in the direction of the market, it's a sign that algorithms might be targeting these levels. Additionally, momentum strategies often operate around breakout points or volatility spikes. So if you see price consolidating and then breaking out sharply on a shorter time frame, say a 5-minute chart, and then maintaining the momentum on a longer time frame like the 1-hour chart, this is likely driven by algorithms looking to profit from momentum. Momentum-based algorithms typically react quickly to small price movements and often need smaller time frames, such as 1-minute or 5-minute charts. However, these algorithms may also confirm their moves on higher time frames, such as 1-hour or 4-hour charts. So, by analyzing both short and longer-term charts, you can begin to spot algorithmic activity aimed at capturing momentum. 3. How can you detect algorithmic trading in the market? If you're wondering how to detect algorithmic trading in the Forex market, there are several tools and methods you can use to spot this behavior. First, keep an eye on order book data and volume analysis. Platforms like MetaTrader, TradingView, and even advanced tools like Bookmap provide insights into the market depth and volume. Algorithms tend to operate where there's a significant amount of volume and liquidity. If you see large, repeated orders or price spikes that don't correlate with news or fundamentals, that's a sign of algorithmic activity. Also, look out for unusual liquidity patterns. Algorithms can create periods of thin liquidity, especially around major news events or during off hours. This means you might see prices moving faster than usual, especially when the market is supposed to be less active. If this happens, there's a strong chance that algorithms are executing trades to capture momentum or exploit price inefficiencies. One more thing. Momentum strategies used by algorithms are often triggered at certain price levels, such as support, resistance, or pivot points, that indicate a potential for momentum to pick up. When these levels align with sharp price moves, it's often a signal that algorithms are actively trading. Conclusion. To sum up, spotting algorithmic trading in the Forex market requires a keen eye for patterns, momentum indicators, and tools that give you insight into the order book and liquidity flow. Algorithms tend to dominate when there's a sharp price movement, and by understanding how they react across different timeframes and market conditions, you can improve your ability to spot them in action. If you found this video useful, make sure to hit that like button. And if you're new to the channel, don't forget to subscribe for more trading tips and insights. Let me know in the comments if you've had any experiences with algorithmic trading, and if you'd like me to dive deeper into any of these topics in future videos. Thanks for watching and happy trading.